The economic survey 23, GDP at 6.5 to 7% and says that India's economy is on a strong wicket amid global challenges. To discuss the key highlights of the economic survey and what it really suggests about the state of the economy, I'm joined by Anubhuti Sahay, Head of South Asia Economics Research, India at Standard Bank, Aditi Nayar, Chief Economist at ICRA, Rao, ED, and Senior Economist at DBS Group Research. But before we go to our guest, let's take a quick listen into what Prime Minister Narendra Modi had said earlier today at the beginning of the budget session of.
ये बजट अमृत काल एक महत्वपूर्ण बजट है। हमें 5 साल का जो अवसर मिला है, आज का बजट हमारे उन 5 साल के कार्य की दिशा भी तय करेगा। ये बजट 2047 जब आजादी के 100 साल होंगे, तब विकसित भारत का जो हमारा सपना है, उस सपने को पूरा करने की मजबूत नींव वाला बजट लेकर के हम कल देश के सामने आएंगे।
Very clearly, the Prime Minister setting the tone for what we can expect budget Viksit Bharat 2047 and Amrit Kaal has played out over several budgets now. But coming to you first, Anubhuti, your key takeaways from the economic survey in terms of that it paints.
So overall, we are yet to see the full document, but whatever we have heard till now, I think a few things stands out. First, when it comes to the FY25 projection, the economic projections are far more conservative, heard from RBI. But all said and done, they have given a range of 6.5 to 7%, which in my view is justified given the uncertainties related on the global side, monsoon. And it's quite interesting to see that the economic survey highlights uncertainty or possibility of private investment turning cautious. So if we get to 7%, which is our forecast, we think it's a pretty good number, given that last year India grew at 8.2%. So might sound conservative in as per the range which they have given, but more likelihood of touching 7%. The second thing which kind of stands out, and again, as I mentioned, we are yet to read the full economic survey, but while they expect the inflation trajectory to remain benign, possibly there is a reference that RBI or the Monetary Policy Committee, is there a need to visit the inflation targeting framework, given that food prices are extremely volatile and at times it can keep the headline number much higher and credit cost far more expensive. So I think that is something which stood out for us. It's a topic of debate, but at our level, our sense is that India's consumer still spends a significant amount on food. If it's 45, maybe 40. It's important that food inflation remains part of inflation targeting. Otherwise, it starts spilling over to inflation expectations and then would highlight them.
Aditi, coming to you with that same question, and just to add that as far as inflation is concerned, the survey says, and I quote, achieving long-term price stability requires a clear forward-looking vision. Hence, assessing progress in developing modern storage and processing facilities is crucial. And then it says beyond the medium long-term inflation outlook will be shaped by strengthening of price monitoring and market intelligence. Add to that, Aditi.
Thanks, Siddharth. Certainly I agree with what Anubhuti said. As far as the consumers are concerned, what they buy every week, every month is dominated by food items and other consumer non-durables. And so these items remaining a part of the overall inflation targeting is really quite crucial. The sense I have is that food prices, in fact, have an inordinate impact on shaping the inflationary expectations of households. So while there can be a debate over whether 4% as a headline target as a midpoint of the target range is appropriate for India at the stage of the development it's in, I do agree that we need to be looking at headline inflation and not just core inflation. Core inflation also contains a large component of essentially imported commodity prices, where again we can argue that our domestic monetary policy doesn't have a direct impact on crude oil prices per se. So if we're okay to include basically imported commodity prices where we're just a price taker, then food inflation, which really sets the agenda for inflationary expectations, must remain a part of the inflation target. Whether the target is appropriate at 4% or do we need to, look at a slightly higher target, maybe 4.5%, I think that's a separate debate. And on the overall growth range of 6.5 to 7%, I again agree with Anubhuti. I think this is a much more realistic range. We're at a 6.8% GDP growth forecast for this year, which is in the pretty much in the middle of this range. Given the fact that last year there was a huge difference between the GDP and the GVA growth, which came in on account of technical things like high growth taxes, contraction, and fees. A slowdown is expected on the GDP growth side. So it's not necessarily a loss of momentum, but part of it is a very technical. And I think this is a realistic range to keep in mind going forward, especially when we've already seen there has been an impact of the election cycle on particularly government capex in the first quarter of this year.
Radhika, as I come to you, and I know you will also want to have a say on the inflation dynamic, but I just want to add two more lines to the debate here. The survey in the fifth chapter speaks about going forward, the government's focus on bottom-up reform and strengthening the plumbing of governance so that the structural reforms of the last decade yield strong, sustainable, balanced, and inclusive growth. It also then adds on, this is important, it says in the medium term, the economy can grow at 7% plus on a sustained basis if we build on the structural reforms undertaken over the last decade. And then a very important line, this requires a tripartite compact between the union government, the states, and the private sector. How would you interpret these two lines, Radhika?
Thank you so much, Siddharth. I think the rest of the panelists have already covered the growth and the inflation dynamics. I think what comes out of this thing are two words for me, especially inclusive growth. I think that has been the need of the hour. Is to, while the economic survey doesn't seem to, the few comments that we have seen doesn't seem to suggest that there's going to be any big bang reform. I think it also acknowledges that a lot of reforms have already been set into motion, and that. One by one, these are yielding results, and that's why you can see some of the delivery, say for example, for subsidies, the direct transfer mechanism, the GST, initial growing pains, but thereafter you've seen very strong takeoff. All of these reforms actually need to mature, and as they mature, you will see more, it'll be more growth accretive, so to speak. So that's been set into motion, but this new approach has to be making it bottoms up to mean that whatever measures are being taken, it needs to be felt to the man on the ground, so that he or she has better propensity to consume, can see a difference in its in his or her incomes, and thereafter saving behavior as well. So that I think that's what we expect from the budget, as well as I think it comes out in the economic survey as well, which is that while it's not going to be a populist scheme, but many of the social sector schemes where allocations could increase would be to reach the consumer on the ground, that he or she sees a material difference. Otherwise, I think you're going to see a very, lopsided or uneven recovery to take off with. The other part you mentioned, right, is that, infrastructure as of now has been a very public sector project, a public sector impetus. Right? Of course, banks and the corporate sector have gone over a tough time in the past decade. Books are cleaner, books are leaner. But at the same time, going forward, it can't be the public sector, be it the central government, be it the states, carry the whole cart forward. They will need to participate the private sector will need to participate. Right now, if you see, it's again, private sector coming in very slowly, but needs to be in a much larger space or larger scale to take the whole agenda forward. So from that angle, I would think that if you see the overall investment spending, for example, in private sector, corporates, so basically households, doing very well in terms of the capex cycle, but we do think that the private sector could also begin to participate. So overall, I think the macro backdrop would be first that reforms that have been already undertaken need to be matured. Benefits will, trickle, will be more apparent. Secondly, all of these benefits need to be felt on the ground. So I think the third bit, which perhaps you will touch upon a bit later, is that, which I found quite interesting, was that they want database integration to mean that there's a lot of data, there's a number of schemes that are being run, but wanting to integrate that data to perhaps make sure that the intended beneficiaries can be targeted well as well.
Radhika, that's a very important point you pick up, and I saw that as well, and I wonder how this will fly in the face of even GST release data not being released, but at least the survey economists and that department has made this very important point. I want to turn to another subject, jumping from the macro to specifically the financial sector and financial intermediation. Over the recent few days, viewers, we have seen both the Reserve Bank of India and the securities regulator about the shifts from to the markets. And while those remarks have been made at different forums, what I want to do is to try and quickly play out what SEBI chairperson Madhvi Puri Buch had to say, and then I want to come to my economists and try and interpret one or two lines that are available in this survey, with the question that is the government also, at least the economic survey makers, highlighting this issue. Let's first try and take a quick listen into what the SEBI chairperson had to say just last week.
If you see the number of young people who have entered that entire process and have lost tons of money, no one could have expected to see that. It has now reached a scale where we believe that the objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative actions? Macro now not into capital formation, but into speculative activity.
So, viewers, what was happening on the screen was at the State Bank of India mutual fund event last Friday at Mumbai. That was the SEBI chairperson. What was playing out on screen, and I'll request my producers to bring that plate up again, because this is the latest paragraph from the economic survey. And let's keep that on the screen as I go across my panel for trying to interpret this. Aditi, I'll come to you. You can see that any corrections in the elevated financial market valuations may have ramifications for household finances and corporate valuations, negatively impacting prospects. Now, in basically less than 3-4 days, US politics has changed, and the question that I'm putting to you, Aditi, is this a forewarning of some sort of policy regulatory intervention? Because the same second chapter, the survey says the government and regulators have to be agile and flexible to intervene with policy and regulatory levers as required. What should the general public make of these developments and remarks, Aditi?
It's certainly a strong statement, and in terms of setting an agenda for policymakers, I think the intent is very clear. How quickly this is followed up with actual policy change, I don't know. Let's see if we get a hint of a firm policy in this direction tomorrow. But I understand where this is coming from, because what we've seen over the last year or two, as the markets sort of revived after COVID, is that there has been a huge wealth effect that has driven the consumption of higher income households. And in fact, overall consumption growth has been quite tepid. Not only last year, growth was around 4%, but even if we take a CAGR from the pre-COVID year to last year, it's still about 4%. But within this, we've got very high consumption growth coming out of high income households, which is in large part being driven by the wealth effect that is coming not only from their own incomes being healthy, but also the wealth effect of what's happening with their stock market portfolios. So I think certainly this is a risk, and it's very interesting that the economic survey has flagged this risk this strongly.
Anubhuti, the question that was being asked in the newsroom, and I am putting that to you, does that mean that some action is likely? Perhaps I'm not confining it to the budget, but whatever policy regulatory levers are example, is there some sort of action likely to reduce the shift of savings away from banks to the markets?
That is something which we'll have to definitely keep a close eye on, Siddharth. But I think if we look at the host of regulatory measures, and I'm not restricting here myself just to the equity markets. If you look at RBI, the kind of measures which they have been taking to ensure that the credit flow is to the productive sector, or to ensure that there is enough transparency when it comes to different intermediaries transaction with consumers. We have been seeing these whole host of measures since October, November 2023, and that it continues. If there was probably a one particular section in the economic survey which talks about derivatives trading. So the question is it about the spot equity market, or is it more about the derivative equity market? Because in there it is more speculative in nature, and can we see an action to that extent? I think we have got more than enough hints, so I wouldn't be surprised if we get to hear something tomorrow itself, but it will be an ongoing process when you talk about a shift away from deposit to equity. And I think it's not only about taking a view on whether a regulatory measure will be taken or not. The bigger questions to answer are like, is there a structural change? There is this whole perception that if I invest more in equity, then I'm taking money away from the banking sector, but it flows down. But definitely it's not long-term money with the banks. They have to do so. They will have to strike a right balance. But I think the regulators will also have to take into account that as the financial savviness of the investors increase, simply putting regulatory breaks might not be the best way forward.
Radhika, there's more that's been said in the survey. For example, it makes this good point that the primary capital markets have facilitated capital formation of 10.9 lakh crore in FY24, which is nearly 29% of gross fixed capital formation of private and public sector companies the year before. It notes the fact that the Indian stock market capitalization has seen a remarkable surge. Its market cap to GDP ratio being the 5th largest in the world. And if we take a look at budget sector performance, real estate up 166%, auto index up 73%, oil and gas 68%, pharma 65%, metals 44%, FMCG, IT, all of them doing remarkably well. Beyond this point, the survey also takes note of the very good health and stability in the banking sector. Should we focus more on that rather than just these headline grabbing remarks?
I think these comments have been coming in. I think the economic survey is trying to capture something that's been happening for the past few weeks. On turn, you've got the financial sector regulator. Now you've got the financial securities regulator also mentioning it in different ways. One from the retail sector perspective, the other one also from certain segments of the market. Especially when it comes to enterprises, below the large caps, there could be, some bubble then. And speaking about your primary market mention as well, certainly a lot more firms now open to the idea of going to the market rather than much more passive about it. And I think it's set against a backdrop of primary market that's not been very active in the rest of the region, for example, right? I mean, some of the bigger countries have not really seen this kind of an attractive. So it's a good thing that there is a source of financing that's available. Often with good, there could be some bad in the sense that there could be weaker firms which are coming in with weaker financials who are getting swept away, with this larger euphoria. And I think that's what the regulators are very concerned about. And to answer your question about whether we should be focusing on the banking sector, I think the linkage being drawn is that if deposit growth slows down, it could be a risk for the banks because then they have to move towards wholesale funding, which tends to be more expensive as well. So a good CASA book is certainly very important for banks to keep their funding costs low. I think that's the linkage that at least the central bank seems to draw and also had made mention on. So ultimately, I think it's the angle of, are there any systemic risks for the financial markets? Are there any systemic risks for the equity markets? And I think that's why the regulators are certainly taking a much more proactive stance. Whether it comes in the budget or outside of the budget, I think this kind of forewarning is certainly not out of place, given the larger euphoria that is occurring. I think insofar as financialization for the retail sector is concerned, I think that's a good move. But when you don't see sufficient money going into, and I think that linkage on growth was made, and I think that's important because if you don't have enough financial savings, or especially savings with the banks, then your capex cycle in turn can also be impacted. So certainly the core idea is to ensure that all of this doesn't come together and cause risk for each other. But I'm not sure whether it's going to be a part of the budget as well. But I think it was more or less some of the macroprudential measures that the central bank and the regulators have been taking for the past 2-3 months at the least.
Viewers, there is a side debate on this matter of, and that's for my panel of very stellar economists, which is how do you treat the gains that are made from fixed deposits? We know how they are taxed versus mutual funds, and whether the government can approach some sort of uniform playing field in this regard. But we are not sure when that will happen and whether that will happen. Let's leave that for the moment. I come to you, Aditi, and ask you about what you have seen in this survey that provides you a hint as far as the government's fiscal policy is concerned. Both the number, the restated number, and the outlook that will be given for the current financial year.
Thanks, Siddharth. No, I haven't been able to go through the entire document. From what I've seen, looking at such a realistic number in terms of the GDP growth forecast, does suggest that we're going to have a realistic number for the nominal GDP as well as the tax buoyancy as well. And I think there we were basically building in two revenue upsides. One is the RBI dividend, and there's not too much of a debate on the size of that. The debate really has been on how much the full budget will increase tax revenue, the tax revenue target as compared to the interim budget. And there we have a view that it will be modest, that if you look at the amount net to the center, it will be only around 20,000 crore. So from what I've seen in terms of the growth forecast, that's quite realistic in this budget. I would imagine that we're not going to get very high growth numbers for tax revenue as compared to what was already there in the interim budget. And similarly for disinvestment and asset monetization as well, I suppose the hint is that we're going to look at numbers which are going to be more on the modest side.
Okay. Anubhuti, I'm coming to you with that very same question, and that is really at this stage with just our day union budget. Do you think that some of the additional money that came through the RBI dividend or buoyancy in tax collections is going to be frittered away for a consumption boost, or will the government choose to continue on the path of fiscal balance? Anubhuti.
So Siddharth, I would, we are expecting some of the extra money to be used for providing higher income to say side. It can take the form of increased MNREGA allocation or one more installment been given under the farmer income scheme. We also think there is space to accommodate some tax relief for the middle income class. Now, one can argue that getting this extra revenue and using it to boost, using it to boost consumption, as you use the word fritter away, that's one interpretation. Not really, I wouldn't interpret it tersely. I think at this point in time, one of the reasons why private sector investment has stayed on the sidelines is the lack of visibility on demand Our view is that this year, the heavy lifting on demand revival, that is the rural demand revival, will be delivered if monsoons are normal. If you look at it, 45% of our employed laborers are in the agricultural sector. And if monsoon is bad, it's inevitable consumption would be weak. But if this positive momentum gets support from slight increases in spending towards rural India or a little bit of tax relief to the lower middle segment, I wouldn't classify that as frittering away. What it can do eventually is that it can bring back demand and probably reduce the pressure at the central government, but maybe years going forward. So I think it's important to keep the demand aspect in our mind when we are looking at this particular budget, and in case if there are allocations towards higher spend which are targeted to boost consumption.
Radhika,
On the capex side, sorry, just on the last,
Yeah,
I
go
don't
ahead.
think on the capex side we don't see any big compromises been made. We think there is enough space to strike a right balance between both consumption related spending as well as maintaining the public capex push.
Radhika, where do you stand on this expectation of consumption versus continuing to remain on a certain fiscal path and trajectory? Because one of the views that I have been picking up in the run-up to the budget is in response to these remarks around the RBI bonanza, where people in government have pointed out that the interim budget had outlined certain extra spending, and the fact that the massive Anna Yojana, that has a free food grain program that for almost 814 million people is continuing, and therefore the sense that I got was that expectations of some big splurge are being tempered. Radhika.
Certainly, Siddharth, I think that debate comes up often on elections, which is that is it going to be populist, is it going to be consumption oriented or capex oriented? To our mind, on the capex front, honestly, there are only 8 months to go in the year. If you see the run rate between April and May, because of the elections, disbursements didn't really happen. There was a decline on the year. So given, I think, to our mind, maintaining the capex size that they already have would be plentiful. So we don't expect any further allocation towards capex. So when I say capex, I mean capital spending under the central government. Of course, overall capex has CPSEs also and states as well, into the mix. When you coming to the revenue expenditure part of it, we do think about, out of the windfall of about 1 lakh crore plus, about 800 crores could be 80 crores could be sent 80,000 crores could be sent towards the revenue OPEX, and there apart from just tweaks to the personal income tax, I would think rural sector will be where the concentration would be higher, especially on the housing markets. So when it comes to the housing for in the rural areas, the Gramin, that program could be allocations that could be increased. Then you've got, of course, Manrega. Then the PM Kisan Yojana could go up from 6,000 to 8,000 in terms of the payment. So those are, I think, smaller changes where we expect money to be spent. Again, I don't think just channelizing money there would be necessarily this is much needed. I think the sector, especially the farm part of the rural sector, has been really exposed and has been impacted by exogenous factors. Nothing that or the central bank could do. So I think it does help provide support. Makes sense to provide some support to those parts of the sector. So the balance will fall. I don't necessarily doing this will get the color that it's of being too consumption oriented. I think the revenue headroom certainly gives them more ammunition to play with, and that allows for higher allocations. But otherwise, I think this emphasis will still be on, if you see the capex to revenue expenditure ratios, all of that will point towards improvement in the quality of expenditure. And I think compared to the interim budget, apart from higher revenues, two other things have happened. One is that you have a wider pool of investors now who will be scrutinizing the fiscal math closely. And the other thing is, of course, you've got the S&P rating outlook change, again, which appreciates or notes of positive changes on the fiscal consolidation quite well. So we do think there is a window that within the 48 months, within 2 years, that we could see, in fact, a change in the outlook upgrade as well. So putting all these things into perspective, the backdrop, increased focus on where the spending goes, I think that mix will still remain in place, but bit of higher allocation to consumption need not make it very populist in our view.
Absolutely, and what you say, Radhika, reminds me of another remark recently that I had heard where people in government said that the hard-won fiscal credibility globally cannot just be frittered away, and I use that word frittered very consciously, Anubhuti, just like that, and therefore over the years one has seen that the economic survey has grown bigger, it's become better, the quality of graphics, the information has become even much better, but it's still a look back with certain tantalizing glimpses of what could happen in the budget, and we will focus on that over today and tomorrow. For now, I'm going to thank all my guests here on the show, as well as you, the viewer, for tuning in. Programming on the economic survey and what to expect in budget 2024-25 continues. Do stay with us. I'll see you again. Bye-bye.
इस बार फिर एक बार
we explain the impact of the first budget of Prime Minister Narendra Modi's third term.
Your investments, your future. How the budget drives India's markets. From taxes to health, Manrega to Ayushman Bharat, we bring you all the policy moves. Expert insights on how Nirmala Sitharaman's 7th budget affects your finances. Decode the big numbers and the new policies shaping our nation's future. Tune in to Business Today for Modinomics 3.0 live on Budget Day.
By ICICI Banking Partner PNB.